Welcome to this explainer. Today, we're going to dive into a massive market crash that almost everyone has completely forgotten about, and see how its eerie similarities to today serve as a seriously powerful cautionary tale. You know, we hear a ton about the dot-com bubble or the 2008 financial crisis, but there was this massive market event in the early 1970s that barely gets talked about anymore. And as we're about to uncover, the setup back then looks disturbingly similar to the current state of our market.
To kick things off, legendary investor Sir John Templeton, a guy who averaged a staggering 15% annual growth for almost 4 decades, had this cold, hard warning for us. He said, "The 4 most expensive words in the English language are 'this time it's different.'" It's such a brilliant point, because nothing empties a brokerage account faster than investors doing mental gymnastics to convince themselves that the old rules somehow just don't apply anymore.
And that danger of blind optimism echoes a really similar philosophy from Jesse Livermore. If you've read Reminiscences of a Stock Operator, you know he was a true pioneer of speculative trading. He reminds us that human nature, well, it doesn't change. Historical market behaviors always repeat themselves. There really is nothing new under the sun, especially on Wall Street.
Okay, so let's get right into the nitty-gritty of this forgotten 1970s crash, often called the Nifty 50 bubble. When this thing finally popped, the sheer scale of the damage was just breathtaking. It didn't just rattle the market, it completely obliterated it. The overall market crashed by half. Some of the most respected companies in the world lost 60 to 80% of their value. And on top of that, inflation skyrocketed from a totally manageable 3% all the way up to 11%.
But to really understand how things got so bad, we have to look at the setup. Picture the late 1960s. Americans were riding this massive 20-year economic sugar high right after World War II. Factories were booming, suburbs were popping up everywhere like mushrooms after a rainstorm, and hey, we had just put a man on the moon. We even invented the Etch-a-Sketch. People had incredible amounts of money, soaring confidence, and most importantly, this absolute blind optimism. The whole country felt completely invincible.
And it is just staggering to see how that unchecked optimism spilled over into the stock market. Get this, from the end of World War II in 1945 all the way to 1970, the U.S. stock market saw a massive 350% gain. That's an unprecedented multi-decade bull run, and it fundamentally changed how everyday people approached investing. Because everything only seemed to go up, right? So this very dangerous new strategy became super popular. They called them one-decision stocks. The whole concept was pretty simple. You find these blue-chip companies that are so powerful, so dominant, and generating such incredibly stable cash flows that you really only had one decision to make. Just buy them. We aren't talking about sketchy penny stocks here. These were bulletproof household names like Coca-Cola and American Express. The prevailing wisdom at the time was that ever selling these stocks was just completely crazy. Now, check out this stark contrast in valuations. While the broader market was sitting at a respectable, totally normal price-to-earnings ratio of 15, a valuation you could happily bring home to your parents, the Nifty 50 stocks were trading at a jaw-dropping average of 42. This whole never-sell mentality had turned their valuations into numbers straight out of a fairy tale.
And when we actually drill down into those multiples, it gets even crazier. Coca-Cola was trading at 46 times earnings, Xerox at 49, McDonald's at 86 times, and Polaroid reached an unbelievable 90 times earnings. Investors were literally pricing these companies as if gravity simply didn't affect Wall Street anymore. But listen, if a stock sounds like a total no-brainer with absolutely zero downside, it is almost always a financial grenade with the pin already pulled. So the sheer danger of this entire bubble really boils down to one specific thing: market concentration. By 1972, that Nifty 50 group made up roughly 45% of the total United States stock market. Just think about what that actually means. Nearly half of every single dollar sitting in a stock market index fund was making a massive bet that these 50 specific, wildly overpriced companies could somehow grow into those ridiculous price tags. And then, reality slapped everyone right across the face. Between 1973 and 1974, the macro dominoes just started falling one by one. Oil prices quadrupled. Inflation jumped to over 11%. Unemployment literally doubled from 4.5% to 9%. And President Nixon effectively ended the gold standard for good. All of these massive macroeconomic shifts triggered a 50% market plunge, kicking off what was the absolute worst bear market since the Great Depression.
Here's the thing. When the broader economy fractures, wildly overpriced stocks don't just gently correct. They get absolutely obliterated. Coca-Cola shares fell over 60%, McDonald's fell over 70%, and Polaroid shares collapsed by more than 90%.
Those magical, so-called one-decision stocks basically turned into one giant financial obituary.
But the real gut punch was the timeline. This wasn't a fast V-shaped recovery like we saw after the 2020 pandemic. No, it took the market 8 long years, all the way until 1981, just to crawl back to the exact same level it had been at before the bubble popped. Investors who thought they were buying eternal growth stocks found themselves trapped in financial purgatory for almost a full decade.
Now, if you're getting a slight sense of déjà vu looking at all this historical data and thinking about today's market, trust me, you are not alone. It perfectly brings to mind that famous quote usually attributed to Mark Twain, "History does not repeat itself, but it does rhyme." The market of 1972 might not be an identical twin to today's market, but it undeniably rhymes.
So let's fast forward to today. The plot? It's basically exactly the same, we've just got shinier special effects now. Right now, just 7 tech giants, you know them as the Magnificent Seven, make up around 36% of the entire index. Just 7 companies are carrying the weight of the entire U.S. stock market. It is eerily familiar to that nifty 50 concentration.
We're talking about the modern echo here. Microsoft, Apple, Google, Amazon, Meta, Tesla, and NVIDIA. And look, are these incredible, highly innovative companies that completely dominate their respective industries? Yes, absolutely. But we have to remember, Xerox, Polaroid, and Avon products were incredible, industry-dominating innovators back in 1972 as well.
But we have to ask, are these giants priced fairly today? Just take a look at the multiples. You've got Google and Meta trading around 28 times earnings, Amazon at 35, Apple at 37, Microsoft at 38, NVIDIA at 50, and Tesla has traded at a staggering 247 times earnings. Just like the nifty 50, these excellent companies are priced as if gravity simply doesn't affect them. They're overweighted, they're overpriced, and they're being worshipped as if they're completely bulletproof.
The really terrifying takeaway here is that investors are, once again, telling themselves the exact same bedtime story. We're acting like there is only one decision to make: buy. We assume these companies are untouchable and that they'll just grow at lightning speed forever. But just like in 1973, all we might be missing is a couple of macroeconomic dominoes to fall, and we could find ourselves right back where they were.
And that brings us right to this incredibly sharp observation from Warren Buffett. He said, "What we learn from history is that people don't learn from history." We are once again staring at a severely top-heavy market, pretending that valuations ultimately just don't matter, and proving his point exactly. Which leaves us with this final, rather provocative thought to consider as you review your own portfolio. Looking at today's heavy concentration and sky-high valuations, are you falling for the same bedtime story? When you look at these modern tech giants, are you secretly whispering those 4 most expensive words in the English language? This time it's different. Definitely something to think about.